Good morning, everyone. This is Barry Knapp from Ironsides Macroeconomics. This is our weekly podcast and video. If you're not already a subscriber to the podcast and our research on Substack, we'd love you to consider at least getting the free emails, as well as we absolutely prefer that you become a paid subscriber. But please subscribe to our YouTube channel as well. We could use a few more on that. We've just begun that process, but we need a few more subscribers to be able to brand it on YouTube. I did remove my tie after my early CNBC appearance this morning, which was hijacked by the Archegos story. You can see a video on Twitter that CNBC extracted from the interview this morning. It's a bit critical of street risk management and allowing this fund to have that much leverage, though I do not believe this was or is a systemic event. There's clearly some more supply and perhaps even some other funds involved in similar positions. I don't really understand why you would have had concentrated positions in media stocks and Chinese internet companies. It's surely not the stuff we've been recommending, but nonetheless, we'll leave that story aside. Our note this week was titled Pandemic Effects. It was released on March 27th. It's a very meaty note with lots of substance. Hopefully the reason why you should be a paid subscriber. We began with some market commentary. We titled that section, Breaks Won't Back Down. And we noted that even with the backup in interest rates last week, and by the way, as interest rates backed up, tech stocks still went down, underscoring the point we've been making that investors tend to overestimate the impact of higher rates on technology stock valuations. There is a true cyclical component to technology and technology company fundamentals. But even with that rate backup, as Fed officials were out in force trying to convince the street that they were not about to even talk about tapering, real interest rates continued to go higher. So in some ways, you could view this as something of a validation of Fed credibility, right? The street does think that, or market participants at least believe that the Fed is intent on boosting inflation and may actually be somewhat successful, at least this year, and those inflation break-evens continue to grind higher. Still, with all that, we had something of a risk-off event. Obviously, we had this hedge fund liquidation. We had very strong selling in SPACs, for example, which we don't really totally comprehend why people fell in love with these blank check companies. What we thought was most really interesting from the market action last week was actually the two big events that speak to our broader deglobalization trend. You had the clogging of the Suez Canal, arguing against, it was yet another supply chain shock, arguing against having your supply chain stretched all over the world to take advantage of cheap labor, which there isn't so much of anymore. And then Intel's decision to get into the foundry business and compete with Taiwan Semi. That to us was a fascinating outcome and goes in that same direction of what we expect to happen throughout this entire business cycle, that supply chain stretched all over the world just don't make economic sense any longer. We did make one tactical change that we wrote about this week, which was to buy a semiconductor ETF and reduce our position in the XLY, or consumer discretionary sector, that we had acquired near the lows a year ago. The idea being we had already taken that sector to a market weight. We wanted to reduce that exposure a little bit further, but we really wanted to increase cyclicality to our technology exposure. Recall, we're market weight in technology, but the technology that we hold, we want to be cyclically oriented because we are still early in the business cycle, and we do expect a real sharp recovery in capital spending through the course of 2021 and hopefully beyond. I'll come back to that shortly. The next section of the report was a year after the pandemic panic and some of the trends that have evolved. Obviously, there were things that were accelerated out of the pandemic panic, but there were also some trends that we think were particularly interesting. So the first one we wrote about, this came from a client call where they asked us about the retailing sector. They asked us about commercial real estate, and they asked us about the broader Reflation Trade. And if I didn't say it a bit earlier, that movement higher or wider in inflation break-evens, even while real rates were contracting last week, is game on for the reflation trade. So we continue to have the strongest confidence in that theme in the near term. But we showed how the retailer e-commerce market share of retailers was already increasing at a somewhat exponential rate from 2016. It was shocked 2+% higher during the pandemic and seems to be stabilizing around that level. However, it is no longer the disinflationary force that it once was for companies that are investing heavily in the so-called multi-channel companies where they have bricks and mortar and they have a strong internet presence. That internet presence is no longer a big drag on margins. You sell things for the same price on the internet as you sell them. And in stores, in a lot of cases, it's really more about convenience yield. So that's an interesting dynamic there. On the commercial real estate front, it's unclear how much work from home there will truly be, but we would note that on CNBC this morning, they announced Challenger Gray and Christmas had done a survey, and 79% of the companies expect to have a hybrid work environment going forward. So this is a real trend, and commercial real estate will be an issue going forward. To be sure, though, most of the loans that have been done over the course of the last 10 years following the global financial crisis have been fairly low loan-to-value type of deals, if they were CMBS deals or loans, but the equity holders are going to get hit. And so business structures that rely on long-term leases and then, selling that space on a daily basis, and you all know who I'm talking about, that to us strikes us as just classic borrowing short, lending long business model, has us kind of scratching our heads. And one of the other things that obviously, when we talked about deglobalization a couple of minutes ago, that's a trend that was accelerated by the pandemic, the disruptions in semiconductors and Suez Canal, and just during the darkest days of the pandemic, all those things argue for further deglobalization. And finally, the pandemic ushered in what we would describe as the most progressive administration since the Johnson administration, taking us back to our 60s analog. So those were big effects we thought worth mentioning a year on from the pandemic panic. We also had a payroll preview in this week's note, and we would say that on balance, the data implies we're going to have a pretty strong report on Friday morning when the markets are closed. We get one of these unusual Good Friday payroll releases. It looks to us like mobility, like the drop in the insured unemployment rate in lockdown nations, so that's New York, New Jersey, California, those point to a stronger report. The 4-week moving average of jobless claims was 749,000 during the survey week, which is the week that has the 12th of the month in it, versus 827 in the February week. The pandemic-related claims in that establishment week were 284 versus 513,000 in the February week. Now, that 4-week moving average was roughly the same, but in that survey week, it was much lower. And we won't have the weather effect in March that we had in February that had such an impact on total payroll gains, but also nearly 2 million people were working part-time that would typically work full-time. So that ought to cause the work week to rebound. So on balance, it should be a strong report, but the broader theme here that we wrote about is that it just doesn't appear that there's that much labor slack this go around. At this point in the previous business cycle, slack was still increasing, wages were falling. Right now, wages have been fairly steady using the Atlanta Fed wage tracker, which is our preferred measure. They do a pretty good job with mix shift. So, it looks like the labor market's a lot tighter, and the whole Fed narrative that we have, nearly 9 million total workers down from a year ago is, of course, true, but we don't think it really illustrates the amount of slack based on our broader measures, things like the jobs openings rate and quits rate and layoff rate and a myriad of 18 other indicators we put together. Finally, in the note this week, we pointed to a couple of political risks worth noting. One is antitrust risk. The Biden administration nominated a Columbia law professor, Lena Khan, to the Federal Trade Commission. She wrote a very interesting paper about Amazon back in 2017. We urge you to go have a look at it, where she really does argue for something we've been talking about going back to August, which is a change in antitrust theory towards structuralism from consumerism or the Chicago school price theory approach to antitrust legislation. And her idea is that if you wait for prices to start to go up, it's too late, that these businesses that are oligopolies or monopolies already have too much control over the marketplace. And so her idea is you shouldn't allow vertical integration with those types of companies. Amazon was an illustration of her point. And she's not going to be the lead commissioner, but it is interesting how the Biden administration is moving towards structuralism that has big implications for people invested in those broad platform companies, and is notable for sure, and could have implications for those involved in merger arbitrage and thinking about vertical mergers on a go-forward basis. We also wrote a section on the Biden tax plan. The Tax Foundation did a very good job talking about the implications of the Biden tax plan, but not just the first order effects, the hit to jobs, the potential hit to investment, but pardon me for a second, but also the implications for debt versus equity. That was one of the things that the Tax Cuts and Jobs Act was likely to lead to over time, was less attractiveness of debt-based financing and improved attractiveness of equity-based financing. This would be good news for the long-term structural risk of the market. We thought that incentive for debt financing was a little bit, or could contribute to instability in the markets over time. So on balance, we still stick to our framework that in order to get a 10% correction, we're going to need a significant tightening of both either fiscal or monetary policy. We don't see that yet. So any of these little downdrafts, like the one associated with the backup in rates last week, we think are, if they're deep enough, they're buying opportunities, but we would continue to be positioned in the reflation type of names. So that's it for me this week. Buried Up Ironsides. Have a good week, everyone. Thank you.